My name is Olga, and this is my channel about startups. And today we have a special guest, Victoria Vanina. Victoria, you have lots of experience in investment banking. You work as associate director in Scotia Bank in San Francisco. And I would really love to ask you a couple of questions about M&A and IPO activities, especially for startups. Thank you so much for coming.
Hi, Olga, and hi, Olga's subscribers. Yeah, very pleased to be here. I would love to tell you more.
Okay, I will then just start right from the questions. So, could you please tell me a little bit about investment banking? What is it for? What is the role of investment banking?
Of course, yeah. So, investment banks typically help companies with three products. It's M&A, mergers and acquisitions. So we help, one company buy another company, and we can be either on sell side or buy side. So on the sell side, we help to sell the company. When we're on the buy side, we help to buy the company. And generally, when there is an M&A activity going on, M&A deal, usually, there are at least two investment banks that represent or that work on that deal. At least one bank on the sell side, and then at least one bank on the buy side. But of course, there can be, two banks on the sell side, two banks on the buy side. Very normal. So M&A is our product number one. Then the second product is equity issuance, and that includes initial public offering or IPO, or any other equity issuance on the public market. Can be, secondary, et cetera, et cetera. And then the last product is debt issuance. So we help public companies issue debt.
Okay, great. Sounds like lots of interesting things to do. And what would be your role in all of that? Like how is your day looking like?
So first of all, it depends, on like what deals you're involved with, right? Besides, working on live deals, for example, if I'm working on a live M&A deal, so I would probably spend 100% of my time, working on the deal, and then, it depends like what stage the deal is on. Could be, if we are representing sell side, then, it could be that I'm working on a teaser or for the sale process, or I'm working on their CIM, the confidential information memorandum. So it's basically like a presentation with all of the information about the company that we are trying to sell, we are helping to sell. Then, with IPO, could be, preparing S1 filing. So it's the official document that the company files with the Security and Exchange Commission. When I'm not working on live deals, then I can work on pitches. So it's basically how we do our marketing. We go and pitch our clients, our services basically. Could be, M&A deal or equity issuance, so that issuance. It depends on the market environment, depends on the economic environment, what makes sense for this or that company to do. If they need, additional liquidity, then we can, pitch equity issuance or debt issuance. If we think that, we found a great target and we think, it would make sense for our client to acquire that company, then we might, pitch that. And usually our presentations or pitches, we call them, they're very technical. It's not just, the basic description of the target company. It's a lot of, financials. Well, of course, if financials are available, the target company is public. Lots of financials, lots of financial analysis, lots of valuations. So my primary skill as an investment banker is valuation of the company. So investment banker would know how to value a company, and would help with that. And basically what we sell, what we do is our advice, right? Financial advice, M&A advice.
So at what stage can a startup be a target for an M&A deal on average?
Well, at any stage, to be honest, it can start at, when people are just getting, starting the company, and I've seen deals like that. Typically typically investment bank is not involved in such deals, right? When the company is very, very early, and the transaction is typically called acqui-hire. So basically, the buyer acquires the employees of the company because there's nothing else, right? For example, two co-founders, decided they have a great idea, and the co-founders are very, very talented, and they decided, to start something. They don't even have funding yet, so they don't have, the product yet, only the idea. But someone, might decide to acquire them or acquire them because they really like, those talented people. And it can be, basically at any stage. And even, of course, when the companies are public, one public company can acquire another public company, or it could be private company acquiring public company. So it doesn't really matter if the company is public or private. M&A can happen at any stage.
And when it's an acqui-hire, they usually pay them what, 1 year salary, 2 year salary?
Like that, yeah. It depends. Again, depends on the market, depends on the industry and the vertical within the industry. But yeah, generally, it would be, probably 1x, annual salary, or 1x of stock of acquiring company.
So what is the price of M&A? Like who pays whom? I mean, how much investment banking are making?
Yeah, so we make fee on each transaction, on each M&A transaction, and basically it depends on what we're helping with, and who we're helping to. As I mentioned, right, we can work on a buy side and help the acquirer to buy the company, or we can work on the sell side and help to sell the company. And usually we structure our fee as a succession fee. So if the deal doesn't happen, we don't get paid anything. The expenses are usually paid. So for example, if, we travel to see, to meet the execs and etc. So those are paid. But if the deal doesn't happen, we don't get paid. If the deal happens, usually it's a percentage of the total deal number. That's what we get paid, and it's a sliding scale. So it can be, 0.5%, can be 1%. So it depends on the amount of the transaction. And then besides that, if the acquirer, for example, needs to finance the transaction, they need, additional debt, because usually companies don't buy another company for, just cash. Some do, they have a lot of cash, but generally companies, prefer to finance the acquisition with, for example, let's say, debt and equity, or just debt, or, cash in hand and debt. And if they need debt, for example, we can help with debt, and it could be, debt issuance in the public market, or debt issuance on the private market, or lending. And not me personally, but my colleagues in corporate banking, they would help the company, to structure the lending, so we can give the loan to the acquirer. That's also how we make money, right? That would be additional. There would be additional fee. Or if the company decides to issue equity to finance, the acquisition, same thing, right? We will help with that, and there will be additional fee for that.
Who is? How does it happen? Is this it's a startup who is coming and looking for someone to buy the startup, or it's more a bigger corporation that is looking for a company to acquire?
Can be anything. Our clients can be anyone, right? The acquirers can be, smaller startups. When I say smaller, I think I've seen even Series A startups, making acquisitions of really, really small startups. Or it can be very large public companies.
Okay, so moving on to IPOs. At what stage a startup usually goes public on average again?
It depends, when they are ready, and if they actually need liquidity from IPO, and if they feel like the market is ready for them to IPO. There are a lot of companies that don't become public. Totally normal. I mean, look at Stripe, for example, right? I mean, yes, there is a rumor they're going to go IPO, but it's a huge company, right? One of the biggest, probably, private companies, and they're still private. Right now, the companies can allow their employees to have some liquidity because of companies like Forge Global, for example, where you can trade stock of a private company. So that's how you give liquidity to your employees and your investors. But basically, you can be big and still private, or you can be on the smaller side. But if you feel like you exhausted all of the resources of private markets, VC funding or private equity funding, and then you want to go to the public markets, then you can do that. I would say in the US, you would probably, the smallest IPO should probably be around 250 million dollars. That would be on the smaller side. And so that means, the total valuation of the company should be probably at least 1 billion.
Because you sell just part of your shares, right?
Yes, exactly. You don't sell kind of the whole company, right? On the public markets, usually it's some kind of number of percentage of ownership goes to public market investors. In Canada, for example, where I spent quite a few years working in investment banking, the situation is slightly different because the market is smaller. So the companies going public, they can be smaller. The smallest IPO I've seen in Canada was probably around $50 million. So you can even do that.
And what is the cost of IPO? Like, how much would an investment banker get or investment bank get?
Yep. So same thing, succession fee, only if, the IPO happens, right? Then we get paid. And usually it's, some kind of percentage, like 4, 5, 6% of the total IPO amount. That will be only our advisory fee. And then, of course, there will be legal fee, and law firm will help to structure the IPO alongside investment bank. And there will be like accounting firm fee. So it's not just us. It's not just an investment bank working on an IPO. There are a lot of professionals who work on that, and generally, so we get paid, but then they get paid separately.
So it can be millions of dollars. It's quite expensive to go public.
Yes.
What happens if no one buys the shares?
Well, usually you get the indication in advance. Why? Because before we kind of start, before the shares start trading, right? We build the book. So we basically would call pension funds, asset managers, maybe hedge funds, and ask them, this and that company, we're gonna, they're gonna go public. Probably, how much would you pay? How much, of the shares would you buy? And then, we would send them the presentation, and the management will make the presentation for asset managers, especially for big ones, for pension funds. And the way we build the book is, we would say, well, we value the company at this, this the valuation of the company we think should be. So, at this price per share, how many shares would you buy? And they would indicate to us, well, this how much, for example, at $10, per share, we would buy this many shares. And it would be like, well, what about at $11 per share? What about at $12 per share? So basically, we usually have a range, and say, for example, 10 to 12, or 20 to 22 dollars per share. And each asset manager who is interested would give us the indication how many shares they would buy at each price. And if we see that the book building exercise is not going well, then the company may decide to withdraw the IPO, and then we don't get paid. But then again, it's kind of bad for us if the IPO gets withdrawn. That means we didn't get our job done beforehand. That means we said the company, well, yes, guys, you will be successful going public, but it did not happen.
And what exactly you do during the IPO? You build this book, you pitch. What else?
So we help with all of the documentation. It's usually S1, or the so-called prospectus. So it's a document about the company, the company's industry, the business description, management, all the financials. So basically everything about the company. And usually it's a huge document, 100 pages. That document gets filed with Security and Exchange Commission, and then Security and Exchange Commission reviews it. In the US, they can take as much time as they want to review it. Then they get back to us with any additional, questions they might have, or request for information. And then, we respond to that, or there might be, no additional questions. And then the Security and Exchange Commission, kind of gives us green light to continue with the IPO. And then we start marketing. So the marketing is usually about 2 weeks, and it's we call it roadshow. So what we do, we prepare the presentation with the management team of the company. We prepare them, how to answer investors' questions and all that. And then we schedule meetings. And it could be, for example, something like a conference setting where a few investors come, to one place, and then the management team, tells them about the company, answers the question. Or sometimes it could be one-on-one meetings especially with large investors, those ones, who tend to buy a lot during the IPO, and that would be one-on-one meeting. So basically it's like pitch, right? It's management team who does the pitch, but we're usually there, helping them to answer any questions. And we kind of coordinate the whole process. We make sure that the checklist for the IPO is all done. So, for example, the company needs to have audited financial statements. So we make sure, we have those ones. We make sure, and we also do due diligence on behalf of public market investors.
And who are these big investors? They are like pension funds? Who else?
Pension funds, asset managers, any big names, so Fidelity, T. Rowe, that is big in pension. So any 401k, pension asset manager would basically be the IPO buyer. Hedge funds as well, they like to buy IPOs sometimes. The companies prefer not to have many hedge funds, to buy into their IPO, because usually they tend to sell the stock pretty quickly, and you don't want to see, such a lot of liquid, a lot of kind of movement in your stock so quickly after IPO.
And my last question, so who sets the price? Like, is it you who is saying, well, that's the final price of a share, or the buyer decides?
So basically, as I said, right, so we value the company initially. We talk to the management team and the owners of the company, of that private company that is going public, and we would tell them like, look, guys, we think, based on the current valuation, we think the company's value should be this. So that means, that would be the price per share, and we have the range. And usually it's, a couple of bucks, difference. So say $10 to $12. And then we go to the buyers in the public market, so asset managers, pension funds, and we tell them, well, this is the price we think it's going to be, 10, 11, or 12, and let us know how many shares you're going to buy at each price. And then basically, depending on the demand, we see, where the price should land. And sometimes it can be, not in the range, which is, it's bad for us. That means, we didn't do our work properly. But sometimes it can be, below the range or above the range.
Okay. Victoria, thank you so much for sharing all your experience and knowledge. Very valuable. Thank you for coming.
Of course. Thanks so much, Olga.
Thank you. Bye.
Bye.